Hi, it's Suzy Rhoades with PassMasters. Welcome to this week's Questions of the Week. This week, our topic is going to be the Series 65 and Series 66 exams, Section 3. We're going to take a section exam from within our learning management system. Section 3 for these exams is exactly the same. It's investment recommendations and strategies. Let's check out our learning management system. The relative strength index is used to measure which of the following: market sentiment, market return, market breadth, or market momentum. You choose what you believe is the correct answer. The relative strength index is used to measure. I believe it's market momentum. Click check answer. You know you got it right because you get that green check mark. You can click show explanation and read the answer. So the relative strength index created by J. Wells Wilder Jr. in the late 70s. It is used to measure market momentum. It indicates to a trader whether or not an issue's price action is created by those overbuying or overselling it. Relative strength index. Some of my students learn by listening. So for every question within our courses, you have the relative strength index is used in audio explanation. Which type of business has unlimited liability for the owner? LLC, S corporation, sole proprietorship, or C corporation? The only one of them that has unlimited liability for the owner is the sole proprietorship. All of those others will have a liability shield for the owners. If a corporate bond yield is 7% and the investor is in a 27% tax bracket, what would the tax-free equivalent be? So let's see. If the corporate bond yield is 7%, does the investor get to keep all of it? No. Do they get to keep 27% of it? No, that's how much they owe in taxes. So they get to keep the complement of the tax bracket owed. So 100% minus 27%. So they get to keep 73%. 100% minus 27%. So what you want to do is find the formula for after-tax yield. That's not what the question said, I know, but after-tax yield and the tax-free equivalent are the same thing. So we're going to take 0.07 times 0.73. That's how much of it the investor gets to keep. You get 0.0511, so 5.1%. It's not math heavy, these tests, but there are a few math questions that you must know. Always use your calculator. I would be remiss if I didn't show you that there's also another way that you can do this question. So we have to look at a piece of scratch paper. So the two key things in this question are a 7% bond and a 7% nominal yield, 27% tax bracket. So I did it the fast math way, and not all students like to do it the fast math way. Remind me, what does this 7% mean? It is the annual interest on the bond. So the annual interest on the bond is going to be $70 annual interest. How much are the taxes? 70 times 27%. Remember, interest income is taxable as ordinary income, $18.90. That's how much is owed in taxes. So 70 minus $18.90 leaves after-tax interest income of $51.10. So after-tax income. And what is par on a bond? $1,000. So if you take $51.10 divided by 1,000, what do you get? 0.0511, 5.1%. So do you get the same answer? You do. Oftentimes students like it this longer way where they can actually see how the math works. It just makes more sense to them. And that's fine. You do have a time limit on the test. Don't ignore your time, but generally students don't run out of time. are the items called that must be added back for the purpose of the ANT calculation? Personal exemptions, excessive deductions, itemized deductions, or tax preference items. The items that must be added back, things like depreciation in excess of straight line or interest from a private activity bond. Those are tax preference items. An investor put $20,000 into a mutual fund. During the year, the fund paid $3,000 in dividends, which she chose to reinvest. The current net asset value of the mutual fund holding is $24,000. What is the total return? Total return is yield plus growth. The yield is $3,000. That is the dividend. And the growth is, 20 versus 24, 4. No, be careful, because it says that the dividends were automatically reinvested. So that 3,000 of the what looks like growth is actually the automatically reinvested distribution. So it's $3,000 in dividends plus only $1,000 in the growth. So yield plus growth divided by what was paid. Yield is 3, growth is 1. So $4,000 divided by $20,000 is 20%. Be careful, that was a tricky one. Paula gifts $15,000 to each of her 10 grandkids this year. The current year's gift tax exclusion amount is $15,000. What are the tax consequences of these gifts? They are taxable to the grandkids? No. They are taxable to Paula? No. The amount over $15,000 is taxable to Paula. $135,000? No. The gift tax exclusion is to as many people as Paula would like to give it to. They are tax-free both to the grandkids and to Paula. So that is an amount that an individual can gift to as many people as they would like. The person receiving the gift never owes taxes. The person giving the gift only owes taxes on the amount over the gift tax exclusion amount. In this case, there was no overage in this question. Noelle and Mason would like to own property together. Noelle will own the property 75% and Mason will own the other 25%. Should one of them die, they would like their ownership to pass on to their heirs. Which type of account registration is the most appropriate? Joint tenants with right of survivorship? No. Asset must be owned equally in that case, and then when one of the tenants dies, it passes to the survivor. Individual account? No. Joint tenants in common or TOD account? It is only tenants in common where the asset can be owned unequally, and when one of them passes away, it will pass on to their estate. Joint tenants in common. When a will lists beneficiaries per stirpes, what does that mean? So there's two types of beneficiary designations. There's per capita, which is per head, or there is per stirpes, which stands for representational or down the pipe. Per stirpes, Latin for representational. Using barbells is an active portfolio management technique for bonds. I like that. It's not passive. That's what it is, barbells. So when you are using barbells, you have bonds that mature in the short run on one side, bonds that mature in the long run on the other side, right? We're lifting the barbell. And then when the long-term bonds get towards the middle, the barbell is really awkward now, right? You sell those long-term bonds and you buy more long-term bonds. So it's an active portfolio management strategy for bonds. Which of the following is not suitable for an investor looking for current income? Government bonds has some income. Corporate bonds has some income. Growth stock pays low to no dividends, has low to no income. Or preferred stock. Preferred stock has a fixed dividend rate. So not suitable for someone looking for current income would be growth stock. Their investment objective would be appreciation. Which type of stock is known for having a low price-book ratio? International, income, growth, or value? It is a defining characteristic of value stock. that the market price trades low at a very low multiple of what the underlying assets say that it's worth. And those underlying assets come from the company's balance sheet. All are ways to manage a portfolio's volatility except, so what is not a way to manage a portfolio's volatility? Diversify by asset class, purchase dividend-paying stocks, investing in a broad index fund, or buying assets with low to no correlation. So which one does not help to manage a portfolio's volatility? Volatility is a measurement of risk. Investing in a broad index fund is in the market. There is no managing the portfolio's volatility when you invest in a broad index fund. But all of the other choices would be ways to manage a portfolio's volatility. Investing in a broad index fund is not. Which statement regarding trading costs is incorrect? Firms can charge both a markup and commission in a single trade. That's incorrect. Let's check the rest. The dealer charges a markup or markdown. The broker charges a commission. The firm can never act as both the broker and the dealer in the same transaction. So those final three are all true. The one that is incorrect, this is false. The firm is not allowed to charge both a markup and a commission in a single trade. That's prohibited. Which of the following would not satisfy the investment objective of preservation of capital, safety? Common stock, where would that be on the risk spectrum? Safe or risky? Risky. We're looking for preservation of capital and safety. So I'm thinking it might be common stock, but never choose the first right answer. Investment grade corporate bond funds, that would be satisfy the investment objective of preservation of capital, safety. That'd be on the safe side. Not that you ever say safe to your clients, but you know what I mean. Money market funds are also on the investment objective side of preservation of capital. Bank CDs are on the safe side. So the answer here is common stock. Common stock is on the capital appreciation growth side of a risk spectrum. A fund that invests in 60% stocks, 20% bonds, and 20% in cash is which of the following? A target date fund. Did you see a year here? No. Asset allocation fund, a certain percentage in a certain type of asset? Yes. Income fund? No. Balance fund? No. It is an asset allocation fund. So various types of asset classes, stocks, bonds, cash, real estate. Those are the major four. Your client has $100,000 to invest today for her 17-year-old son's college education. Which of the following would be the most appropriate recommendation? An educational savings account, an index fund, a bank CD, or a ladder of treasuries maturing over the next 5 years? Well, ESAs are educational savings accounts, but the kid's at 17 already. Index fund, bank CD, no, I don't know. I mean, I have college kids. Thank goodness they don't ask me to pay for it all at once. But a ladder of maturities over the next 5 years, and you know, I'm going to hope that my kids graduate in 4 years. But the most appropriate of these four choices, a ladder of treasuries maturing over the next 5 years. So those are on the conservative side of the risk spectrum. This is money that we're going to be needing soon. In a UGMA, UTMA account, all are true except what is false in a UGMA, UTMA account. The assets in the account become the property of the child when they reach the age of majority. That is true. The custodian must be the parent. That is false. The custodian must be someone of legal age. Oftentimes is the parent, but does not have to be the parent. The minor social security number is used, true. There must be one custodian, true. So the false statement, the right answer to this question, the custodian must be the parent, not true. When a qualified plan is non-discriminatory under ERISA, it means that The assets are managed for the benefit of the participants. Well, I mean, that's a good thing, but I don't know if that's the right answer. There's a uniformly applied formula that determines employee benefits and contributions. Non-discriminatory, I like that. Let's check the others. All eligible employees are enrolled, or employees must be automatically enrolled when they meet the eligibility requirements. When a qualified plan is non-discriminatory under ERISA, it means that there is a uniformly applied formula that determines employee benefits and contributions. So it's not just in favor of those that make more than others or that have been here longer than others. There is a formula that determines it. When comparing buy and hold with rebalancing, which is the most important consideration? Buy and hold is more aggressive. Rebalancing is more conservative. Rebalancing has higher transaction costs, or buy and hold has higher transaction costs. So rebalancing means that you look at your asset allocation and once in a while, not weekly or monthly, maybe once a year or twice a year, you make sure that you have the right percentages of assets and things like cash, stocks, and bonds. When you do that, when you sell something to buy something else, you do have higher transaction costs. Rebalancing has higher transaction costs than buy and hold. Your client believes that offshore drilling is bad for the environment. This is a financial goal, non-financial investment consideration, financial objective, or opinion that is not relevant when giving investment advice. It is within your realm of responsibility to make sure that you take into account both financial considerations as well as non-financial investment considerations. So what are your clients' values and attitudes, their investment experience? What are their beliefs related to environmental, social, and governance investing? You will consider all of those things. The capital asset pricing model is used to calculate the return that an investment blank achieve based upon the risk taken. So the capital asset pricing model is used to determine expected return. So the return that an investment should, will not be able to, will, or is guaranteed to. What's the best word for that? It is what an investment should achieve based upon the risk taken. So when we do a capital asset pricing model formula to determine a security market line for an individual security, we're going to use the beta to adjust for the risk. Remember, when an investor takes on higher risk than the risk-free return, what do they expect to earn? More. And it's a capital asset pricing model that will show us what that more is. What is the expected return for an asset? Not a guarantee, of course. Portfolios found below the efficient frontier are efficient, inefficient, unattainable, or optimal. Portfolios found below the efficient frontier are inefficient. You want a portfolio to be found on the efficient frontier. If it's above the efficient frontier, then it is unattainable. Below, it's inefficient. Premature distributions from a traditional IRA are subject to a 10% early withdrawal penalty. There are some exceptions to this penalty. Which of the following is not an exception? Qualified educational expenses, behind in rent, death or disability, or $10,000 towards first-time homebuyer expenses. So of those four, which one's not an exception to the 10% penalty? Behind in rent. If your house is going to be foreclosed on, you could argue for that one. It really would depend upon the plan, but behind in rent would not be a reason why the IRS would waive the 10% early withdrawal penalty. When a will lists beneficiaries per capita, what does that mean? I said this before. Per person, primary, preferential, or representational. Per capita is per head, so it is per person. So if you have a will and you have 3 beneficiaries and they're all alive when the person's whose will it is dies, then the assets will be distributed 1/3, 1/3, 1/3. per head. If 2 of the 3 are alive, then they'll be split 50-50. That is if the will beneficiaries were listed per capita, per person, per head. Which of the following would not be able to fund a Keogh? Independent contractor, CEO of a corporation, a freelance photographer, or a self-employed yoga teacher? So Keoghs are qualified plans for the self-employed. A CEO of a corporation is not eligible to fund a Keogh. Which of the following is a non-financial investment consideration? Projected retirement income, risk tolerance, tax bracket, current income. So we have financial considerations, which are dollar amounts. And then we have non-financial investment considerations, things like attitudes and values and risk tolerance, non-financial. The rest are all dollar amounts or percentages or numbers, if you will. Which is incorrect regarding Keogh plans? Contribution limits are much higher than those found in IRAs. That is true. Corporations cannot establish Keoghs. They are intended for self-employed individuals. That is true. They are non-qualified plans. They are qualified plans. So we're looking for the false statement. Corporations cannot establish Keoghs is true. They are non-qualified plans is incorrect. Keoghs are qualified plans. So be careful. Sometimes the wording even confuses my brain. So it's not a race to the finish. You want to pass the test. Don't ignore the time, but in general, you'll be fine. Which of the following can be subject to the claims of creditors? A will, a trust, a brokerage account with a TOD, or a bank account with a POD. There's only one of those 4 that can be subject to the claims of creditors, and that is the will. So when you have a financial asset with a TOD or a POD, that cannot be attached by creditors. A trust cannot, but a will can. So when there is just a will, it goes through the probate process, which opens up the assets in the estate to claims of creditors. State securities regulators are responsible for which of the following? Handling customer complaints, state securities registration, handling arbitration disputes, or registration of registered representatives. State securities registration is the answer here. So arbitration disputes, those are handled through FINRA. The firm should handle customer complaints. Registration of registered representatives is also done through FINRA. If it had said registration of agents, then I would have said the state. In order for a security to be sold in a state, it must be registered in that state. In managing a portfolio's volatility, it is best to look for investments that have the same beta factor. That would mean they would move in the same relationship to movements in the market as a whole, have low to no correlation, move together, or are highly correlated. So if you're trying to manage a portfolio's volatility, do you want things to move together? That would be a positive correlation. Or do you want them to move the opposite of each other? That would be a negative correlation or no correlation. That would help to manage a portfolio's volatility. So negative 1 would be the opposite of each other. So if a stock's up 10%, then the other stock's down 10%. No correlation just means that there's no relationship that you can track. So when you're done with an exam, you'll click Finish Exam. We got 100%. We passed. Great job. I'm going to click View Score Report. You can see the section that we just took a quiz on, investment recommendations and strategies. It is 30 questions. It is 39 on Series 65. When you click the down arrow, you can see all of the topics from the content outline that are within this section. So this is how I lay out the course. So types of clients, 2 questions, client customer profile, you had 6, capital market theory, and so on and so forth. So all of the quizzes are properly weighted, just like you will find when you go down there and take the actual exam. So these are all of the topics that you will find within section 3 of either the Series 65 or Series 66 course. Thanks so much for doing this quiz with me. I hope you learned something. Be sure to give this video a thumbs up, subscribe to our channel, turn those post notifications on. If you have any questions related to this video, please ask me in the comments below. If you'd like to check out PassMasters Securities course offerings or to enroll in any of our programs, there's a link found in this video's description. Keep up the good work. Happy studies. You got this.